Welcome back. Today we are going to continue Chapter 24, Responsibility Accounting and Performance Evaluation. We have just finished part 1 of the chapter, and today we are complete or continue what did we start, and we stopped at learning objective number 4, which is using return on investment and residual income to evaluate the investment center. How does performance evaluation in investment center differ from other centers? Actually, we discussed in part 1 the cost center and the revenue center and the profit center. Actually, here we are talking about the investment center. The evaluation of investment center must include two factors. First of all, maximizing the amount of income the center is generating. This means we are talking about revenue and cost. Second is to use the center's assets and resources in an efficient way. We have to make sure that the manager that is responsible for investment center to take into consideration those two. First of all, we can use the return on investment. Return on investment is one of the most commonly used KPI for evaluating an investment center. Okay, the ROI is to be measured by dividing the operating income. In some cases, we are calling them the EBIT, earning before interest and tax, over the average total assets. The average total assets is to be calculated as beginning balance of assets plus end over 2. This is the average total asset. Whenever we are dividing the operating income over total assets, we are trying to reach for an approximation for each $1 to be invested in assets will return the company that amount of income. So actually it is a profitability measure from the beginning, and we can use it specifically to find out the return on specific. The return on investment, which is the profit margin, is a measure also of a profitability. And as we said, we are dividing the operating income over net sales. Net sales, not the total assets. This is another important measure of profitability to measure the return of specific investment. Number 3 is the asset turnover ratio, and it is a measure of efficiency. And this is telling me for each $1 of assets, this $1 has contributed in generating this amount of sales. The higher the ratio, of course, the better the indicator and the better the performance is. Residual income. Actually, residual income is one of the most uncommon key performance measure that is used to evaluate the investment center financial performance. And actually, the residual income consider both the division operating income and the average total asset, and it achieves the goal congruence better than the ROI, which means the residual income is to be used and giving better indication than the ROI investment. How to calculate the residual income? As we said, it is a measure of profitability and efficiency, and it is computed as actual operating income, the EBIT, minus minimum acceptable operating income. And how to calculate the minimum acceptable operating income? By multiplying the target rate of return by the average total asset. Again, operating income maybe 100,000, target rate of return maybe 10%. Okay, and the average total asset is 1 million. So actually here operating income is 120,000. So 120 minus 100, which is 20,000. This is to be called the residual income, the income that have been achieved above the target rate of return by the investor. How does performance evaluation investment center differ from other centers? Actually, as we said, investment center KPIs are including return on investment, which is the ROI, return on investment, which will equal the profit margin ratio multiplied by the asset turnover ratio. And this is operating income over net sales multiplied by net sales over total assets, And if we are going to eliminate this net sales with this mathematically, so it is operating income over total asset, and this is what we said from the beginning. The main advantage of that ratio is expanded equation provide management with additional information on profitability and efficiency. This is profitability and this is efficiency, because it's telling me the contribution of each dollar to be invested in assets in generating that part of sales. Management can compare the ROI across divisions and with other companies, because it is very common and it is used by everyone. ROI is useful for resource allocation, because actually it will direct my resources toward the one that is using that resources more efficiently. And on the other hand, the residual income, which is the operating income minus average total asset multiplied by target rate of return, and we just said, and we are saying that the main advantage of the residual income, it promotes goal correctness better than the ROI, because actually it's telling me straightforward how much did we achieve above the target return by the investor. The equation incorporates management target rate of return, and the management can use different target rates of return for divisions with different level of risk depending on the expectations of the management. What are the main limitations of the financial performance measure? Management should keep in mind that the drawbacks of ROI and RI are related to two main issues: measurement issue and short-term focus. Let's see what do we mean by the measurement issue. Means that we are using the average total asset, and it is measured at a specific point of time, because as you know, the balance sheet is showing the balances at a specific point. So actually here we are taking average in order to make it more smoother, the numbers more smoothen. Why? In order to reflect an average of the total asset during the year. If you have more information and you can get مثلا an average for the 12 months, this will be better because the numbers will be more realistic. Non-productive assets may be ignored in calculating the average total asset. Because actually it will be, if you are calculating the return on investment for the active assets only, so actually the non-active assets will not be included. If we are using a total, so actually again you are making a big mistake, because you are including the active with the non-active assets. The other main issue here is the short-term focus. The decision that benefit the company in the long term may be ignored for a short-term gain, which means if we are calculating the ROI or the RI, we are talking about the benefit for the company in the short term. طب what about the long term? فهير you have a different opinions related to what should be done in the long term and what should be done in the short term. The learning objective number 5 is to determine how transfer pricing affects a decentralized company, and the transfer pricing is a topic. Actually, when company decentralize, one responsibility center may transfer goods to another responsibility center within the company. Which means if I have a product and this product must pass by 3 departments, A, B, C, actually when A will send his work in process to B, this can be against a fees to be collected by department A from B, if each of them is a separate center. So actually this will be called as transfer price. Or maybe the transfer price will be the price that one division in one country will send its output to the next department in another country. So again, this will be considered as the transfer price. This is why we are defining the transfer price as the transaction amount for one unit of goods when the transaction occur between division within the same company. This is the transaction cost between departments inside the same company. What is the main objective of setting transfer price? What should I do that? Because actually both or all that departments are included inside the company. It is owned by the same company. Why should I set a transfer price? We have two main objectives in setting transfer prices. First, to achieve goal congruence, which is selecting price that will maximize the overall company profit. And this is the main objective of the company. Second, to evaluate managers of the responsibility center involved, because actually they are going to try to find out the best price for their outputs, and then to efficiently utilizing their available. The transfer price can be in a range that extends from variable cost to outside market price. Maybe I will calculate it according to the variable cost. The minimum transfer is the variable cost per unit, as we know, according to the relevant cost decisions. And the maximum is the price outside the company, which is the market price. Yani the transfer price will range from only to cover the variable cost, the relevant cost, as we used to say in relevant costing. And the maximum will be the market price that you can sell that product for in the market. The transfer price, as we said here, we have 100 units. As you can see, this is the market price, and we have variable cost, which is 60,000, and the contribution margin of 40. So again, here the market price is 100. So actually the negotiable range is between 60 and 100, because you are negotiating about the contribution margin. But you cannot go here, because once you are there, you are losing money. Operating at capacity. If the selling division is operated at capacity, use the outside sales price, the market-based transfer price. If we are operating at the maximum capacity, we can use the outside sales price, which is the market-based transfer price. An opportunity cost is the benefit given up by choosing an alternative course of action. What is opportunity cost? Opportunity cost is the foregone cost to take one decision rather than taking another decision. And this opportunity cost must be considered in most of our decisions in order to find out the most optimum decisions or alternative for money. If the company is operating below capacity, if the selling division has excess capacity, the division should use the cost-based transfer price. If we have an excess capacity, we have to use the cost-based, because actually this will give chance to you to accept more orders. But if you are produce or operating at capacity, it will be better to use the market price, because actually you are at full capacity. Other issue related to tax consequences between international location. Maybe in some cases the companies are intending to transfer products from one place to another in another country in order to get tax benefits. And another issue is difficulty in determining market price in some cases. Maybe in some cases we cannot determine a market price for a semi-manufactured product or working in process final products. So actually here, those are two issues that we have to consider whenever we are talking about the transfer price. Actually this will, and by that we ended chapter 24. And actually chapter 24 have discussed too many important issues related to the evaluation of performance of multinational companies, the use of transfer pricing. We already have been introduced to the balance scorecard, and this is one of the most famous tools to evaluate the performance of companies. And we already got introduced to different types of centers, cost, profit, revenue, investment, and how we can evaluate the performance of all of these centers. Thank you for listening. See you in another chapter soon.